Well, it looks like it's time for the Chapter 11 exam review. So here's our first question. XYZ company incurred $131,200 of fixed cost and $147,600 of variable cost when 3,600 units of product were made and sold. If the company doubles the volume within relevant range, we should know what that means now, the total cost per unit will be what? Okay, so let's put this in a little chart form. And we are currently making 3,600 units, and our variable costs currently are $147,600, and our fixed costs are $131,200 currently, which means our total cost at this volume level of 3,600 is $278,800. Now, if we want to find out, they want to know if the company's volume doubles, that is, if we go from 3,600 units to 7,200 units, the total cost per unit will be what? Okay, well, the current total cost per unit would be this total cost, variable and fixed together, $278,800, and that would be divided by the 3,600 units, and our total current cost per unit is $77.44. Let me repeat that. You take the total cost of $278,800 divided by 3,600 units, and you will get $77.44 to the nearest unit. They want to know what the cost per unit will be if we double the volume. So if we double volume, let's take, we know that variable cost per unit is equal to the total variable cost divided by number of units. So there's total variable cost, there's number of units. We're going to find out the variable cost per unit. So $147,600 divided by 3,600 units is going to give us a $41 cost per unit right now, okay? And that's going to be 7,200 units. If you multiply that times 7,200 units at $41 per unit, then we'll get a total variable cost of $295,200 because variable cost per unit doesn't change. Variable cost in total changes as volume goes up. So if we double volume, then we ought to have the double amount of variable cost total. And $295,200 is twice the $147,600. So we've just doubled our volume, so our variable cost in total will double. So that goes up here. And then now we get back to that first concept I was talking about, which is if fixed costs are within the relevant range, even when you double volume, that means your fixed cost going from 3,600 units to 7,200 units will be the same. Same 131,200 because it's within the relevant range. So we'll add these two pieces together. At 7,200 units, we've got variable cost total 295,200, 131,200, was our total fixed cost. And that will be a total of 426,400. Take the 426,400 divided by 7,200 units. That'll give us our cost per unit, total cost per unit, at the doubled volume, which will be $59.22. And what I'm hoping you'll see here is that as you increase volume, fixed cost per unit goes down, or we'll talk about that more. That's really what's going on here. Fixed cost per unit is going to go down. Okay, our second problem. XYZ company incurred $79,200 of fixed cost and $92,400 of the variable cost, and that's when units volume was at 2,800 units. Now, if we increase the volume to 3,300 units, our total cost per unit will be what? Similar kind of problem. We're currently operating at 2,800 units, and we want to jump that up to 3,300 units, and what will be our total cost per unit at the higher level of volume? So variable costs currently are $92,400, and fixed costs are currently $79,200. Total cost are the sum of those two, $171,600. If we divide that $171,600 by 2,800, we'll get the cost per unit, which is $61.29. And then if we take the variable costs of 92.4 divided by 2,800 units. At that level, you will get the cost per unit in variable costs, which is $33. Multiply that times 3,300, which is our new volume level we're trying to achieve. That gives us 108,900 as the total variable cost at the new level of volume. And then, as you should know by now, fixed costs are the same. They're going to be the same. And even if it doesn't tell you up in the problem, you should assume it's the same. That is, we're within the relevant range of volume. We should assume it's the same unless you're told differently. So add these two together. That is the variable cost total and the fixed cost total. You get total cost of 188,100. And you can divide that by the 3,300 new volume level, and you should get $57 is your new total cost per unit. Let's go to the next one. XYZ pays its sales staff a base salary of $4,700 a month plus $3.70 per commission per each unit it sells. So there's a fixed cost there and there's a variable cost there. And they want to know if a salesperson sells 670 units of product in January, he'd be paid how much? This is, of course, before taxes. So you take, and his total cost, which in this case would be the total salary, would be the fixed cost, which doesn't change, $4,700, plus the variable cost, which is going to be $370 per unit times 670 units. And that gives us a total of, he's going to be paid $7,179. Let's take a look at the next one. Okay, for the last 2 years, XYZ company had net income as follows. Year 1, their income was $89,000. Year 2, their income was $109,000. What is the percentage change in income from year 1 to year 2? All right, so the percentage change is the analysis year, which is the year 2, minus the base year, which is year 1, divided by the base year. Now, very important idea here, very, very important. If the base year is 0 or negative, no calculation can be made. You can't make a calculation because you're talking about infinity here. You just can't do it. So repeat that. If the base year is 0 or negative, no calculation can be made. We don't have that situation, but that's in case we did ever. So the percentage change, we're taking 109, year 2, minus year 1, which is 89. That difference looks like it's about, what, $20,000, something like that. And divide that by the base year, which is 89, and we get that the change, that, by the way, that was 20,000. 20,000 divided by 89,000, the base year. We have an increase from year 1 to year 2 of 22.47%. Next question. We have all this information given to us. They want to know what is the company's contribution margin. They gave us sales, cost of goods sold that are fixed, cost of goods sold that are variable, gross margin, administrative salaries, depreciation, supplies, which looks like that's a variable number. Now, contribution margin is this. Contribution margin is revenues minus variable expenses. So our revenues are $63,860. And our variable expenses are the cost of goods sold that's variable. And it looks like the supplies, that's variable also. So revenues are $63,860. Add these two variable expenses together and then subtract them from revenues. And our contribution margin in total, that's the way you should say that, is $29,140. Next, we've got what is the company's contribution margin? Well, we just said contribution margin is sales minus variable expenses. We've got two kinds of variable expenses here. We've got variable manufacturing cost and variable selling and administrative expenses. So we'll take the revenues of $253 and subtract out the sum of the variable manufacturing expenses of $86 and the variable selling and administrative expenses of $31. Add those two together, subtract them from $253, and we'll come up with contribution margin in total of $136,000. Next question. They want to know what is the total, the company currently earns a total contribution margin of what? All right, so the company currently produces and sells 43,000 units of product with a selling price of $13. The product has a variable cost per unit of $5, and we have fixed cost of $53,000. So what's the contribution margin? Contribution margin, just what it's been for forever, selling price minus variable cost, or sales minus variable cost in total. So let's do that. So we'll take the $13 selling price minus the $5 variable cost per unit. That's $8. That's a contribution margin per unit of $8, but we don't want it per unit. We want it for the volume we're operating at, which is 43,000 units. So $8 contribution margin per unit times 43,000 units gives us $344,000 worth of total contribution margin. So there it is. Now, next question. XYZ produces a product that has a variable cost of $450 per unit. The company's fixed costs are $56,000. The product sold for $8 per unit, and as the company has desired and to earn a target profit of $17,500. What is the amount of sales that will be necessary to earn the desired profit? So they don't want number of units. They want the sales dollars that you have to earn that profit. And again, that profit is $17,500. So contribution margin per unit is the first thing we'll start with, which is selling price minus variable cost per unit. In that case, it's going to be $8 selling price minus $450, which is our variable cost. So our contribution margin per unit is $3.50. That's our first calculation we've got to make. Next calculation we've got to make will be the break-even point in units. But we're not really going to do break-even. What we're going to do is a break-even that's modified, because break-even in units is usually just fixed cost divided by contribution margin. But we don't have that as a question. What they want to know is the desired profit. So what you have to do is this. You have to take the fixed cost and add to that another, you might say, another kind of fixed cost, which is our desired profit level, which was $17,500. Because you got to not only sell enough units to break even, which is recovering all your fixed costs, but you got to also sell enough units to break even plus get this desired profit. So that's really like another cost to you. So we add these two together and then divide that by the contribution margin per unit. And when you do that, you get the fixed cost that we get us to break even, $56,000, plus the desired profit level, which is another $17,500. Add those two together, divided by the contribution margin per unit that you figured up here, and the answer in this case for units to break even would be 21,000. But the problem doesn't want to know that. The problem wants to know how many dollars, sales dollars, you're going to have to break even. Well, the way you get from units to sales dollars is to take those units and multiply them times the selling price. So we're going to take 21,000 units. That's the level of units to get us to our desired profit margin, times $8 selling price per unit. And our sales volume, our sales dollar amount, should be, to make this isn't really break even, this is the desired profit level in dollars. That's what this should say. Is going to be $168,000. So that is the end of that question. Next, we want to know what is the volume sales in units. Now this time we're looking for units, not dollars, but sales in units required to achieve the target profit. And our target profit is $21,000. So we have to make some calculations here. We got to do, for example, we got to come up with the contribution margin per unit. And we've also got to plug in the fixed cost and the desired profit, because again, those two are really fixed costs that we are then dividing by the contribution margin per unit. So in this problem, the fixed costs were $42,000. The desired profit level was $21,000. Add those two together. That's you've got to sell enough things to have looks like $63,000 worth of profit to generate here. And so 43,000 divided by the $12 selling price minus the variable cost of $6 gives you a contribution margin of $6. So let's see if we can go a little bit further with that. So we have got to sell enough to recover $63,000, and we're making $6 a unit contribution margin every time we sell a unit. So we divide the $6 into 63, and the sales volume we got to have to achieve a profit of $21,000 before taxes is 10,500 units. Next question. XYZ company has a break-even of $800,000 in total sales. That's the sales dollars they got to have to break even. Assuming the company sells its product for $80 per unit, what is the margin of safety in units if it sells $1 million worth of sales? Well, they want to know the margin of safety in units. Well, the margin of safety in sales dollars would be the million that they're currently operating at minus the 800,000 that they'd have to break even. So the margin of safety in dollars is 200,000, but they don't want that. They want to know what the margin of safety is in units. So let's figure that out. So margin of safety is the budgeted sales. In this case, like it'd be $1 million, minus the break-even sales, which would be 800,000. That's margin of safety, like I said. And that would be 200,000, but that's in sales dollars. We want it in units. So to transform that sales dollars into units, we'll take the margin of safety in dollars and divide it by the selling price. So that will be $200,000. That's our margin of safety in sales dollars. And the selling price is $80 per unit. Divide that $80 into 200,000 and get 2,500 units. So our sales could drop 2,500 units before we started losing money. Or you could say our sales could drop $200,000 before we started losing money. That's what margin of safety is all about. Next, XYZ company's break-even point is 30,000 units. Its product sells for $26, that's selling price, has a variable cost of $15 per unit, and they want to know what is the company's total fixed cost amount. This is a very important problem. This may not have anything to do with anything you're doing on the test or whatever, but this is a very important idea that's about to come up in this problem. So you take this idea that sales minus variable cost minus fixed cost equals either break-even point, which is 0, or profit. So that's kind of a little equation you start with. And then let's plug in the things that we know from this up here to see if we can come up with these fixed costs. So we know that we're operating at 30,000 units. We know that the selling price is $26 per unit. So $26 times 30,000 units will give us the total sales. That's one piece right there. We also know that at these 30,000 units that our variable costs are $15 per unit. Multiply those two together and you come up with total variable cost. So we've got sales piece, we got the variable cost piece, and we know that we're looking for not a profit, but we're looking for break even, which is going to be 0. So we've got we got 3 of the 4 pieces. We just have to solve for it now. We can do that by saying that our sales are going to be $780,000. Our variable cost, 15 times 30,000, is going to be $450, and 780 minus 450 gives us a contribution margin of $330,000, which is, we're right on the cusp of getting this real important idea, which is that at the break-even point, here's our big idea. At the break-even point, fixed cost equals contribution margin at the break-even point. So all we figured out here was sales minus variable cost, which is contribution margin, and we should know that if that's the contribution margin we come up with this formula, then we should know that the contribution margin is the same thing as the fixed cost, because that's what it would be at zero profit, which is the answer we're looking for here. So the answer, fixed costs are $330,000, and that's because we're at break-even point. Very important idea here. Okay, let's look at the last one here, which will be like a problem or a homework problem you've already had. Should know how to do this, but it's going to be something like this on the test. So here are XYZ company's annual fixed costs. We got depreciation, officer salaries, long-term lease, property taxes. These are all fixed costs. They want you to determine the fixed cost per unit of production, assuming that XYZ produces either 8,500 units, 9,000 units, or 9,500 units, and they want you to round your answer to the nearest two decimal places. So step one is you got to figure out what the total fixed costs are. So you add all these up. Total fixed costs are going to be $293,000. You're halfway there now. So if we want to find out the fixed cost per unit, each of those levels, we just take 8,500, 9,000, 9,500, and we put in there our fixed costs, which are going to remain the same because it's all within the relevant range of 293, 293, and 293, which is going to be the same number. And we will then, our almost last step here, take B and divide it by A, which is the number of units produced, and this will give us our fixed cost per unit at 8,500, 9,000, and 9,500. And so the most important idea of this problem is this, that fixed cost per unit decreases as production increases. That's all I've got, and good luck.